The point is that wherever you're at, the 1031 can be shaped to be where you want to go. But you got to start first.
Right.
Otherwise, you'll end up with paralysis analysis. If you come to Dave, what should I buy for my first property? Or don't throw a dart. Just buy one. Get started. For us, it was we wanted to go live on a sailboat. You live in Denver. How do you do that? Become a real estate investor. You use 1031 exchanges and primary residence exemptions to move your portfolio to Florida to buy a sailboat with tax-free dollars and raise your children on it for 10 years while you live off the money from your fleet of vacation rentals. That was our story. So no matter where you're trying to get to, I think there's a way.
Real estate investors should not be paying taxes, period. Our guest today has spent decades helping people like you maximize tax benefits. His primary vehicle and specialization is the 1031 exchange, a section of the tax code that helps real estate investors postpone or even totally avoid taxes.
Dave Foster is the founder of the 1031 Investor and author of Lifetime Tax-Free Wealth. He really brings the goods in this episode and tells you how you can keep more money in your pocket. Let's get in the Champions Corner with Dave Foster.
Dave Foster, thanks so much for joining us on the Cashflow Fight Club podcast. We're looking forward to a fun conversation.
Hey, it's awesome to be here. I love to be in the cage with you.
That's right. Let's go. You want to kick us off?
Sure. Dave, why don't you tell us a little bit about your background and what led you into doing what you're doing today?
At some point in time, way back years ago, two people sat down and said, we want to simplify our life. How can we do that so we could get off the corporate train? And I don't know who it was, but somebody said, let's become real estate investors. It'll be easy. And here we are 30-something years later. I wouldn't say it's always been easy, but it's been good. We started on a journey of real estate investing. And I'm addicted. I love everything there is to do with real estate, but I also hate paying taxes. And those two things have come together very nicely in the career that I've chosen to do and how we've chosen to proceed.
Yeah, that's great. We share and feel your pain. We not too dissimilar of a story. In 2016, we also decided to leave corporate we decided not to go back into corporate, decided we were leaving. So we found ourselves out of work and we decided to get into real estate. And after a couple of years of building a successful business, we felt the same tax pinch and we were like, ouch, we got to figure out a way out of this, or at least to minimize it.
But certainly share your to this day. I lose sleep over my first deal where I thought I made so much money buying and fixing up this duplex in Denver. My accountant said, you're going to write a $30,000 tax bill. And that just did not seem, that was not the whole it'll be easy dream, right, for real estate investing. But it was at the down what we're going to talk about today, the 1031 exchange. And the difference my life would have just from that one transaction, if I would have been able to keep the 30,000 working for me for 30 years, just imagine. Wow. Instead, I just could have some sleepless nights wondering.
There are all lessons in there.
Let's definitely start with the basics and in plain English, please, for me, for dummies like me, or for anybody that has never heard about this term 1031. What is 1031?
1031 refers to the code in the IRS statutes. It's section 1031. So just came to me 1031 exchange, or you may have heard it called a tax deferred exchange, or in some cases, there's people that call it starter exchange. It's all the same thing. And it's based on the premise that the IRS allows you. Oh, and by the way, this has been part of the tax code for over 100 years. So it's not anything new. It's not anything exotic, but I don't think you would ever imagine the IRS is going to advertise it because it costs them money. So it's something you have to learn on your own through the campfire grade. But what Section 1031 allows you to do is to take real estate that you either have profit in, it's grown in value, or that you have taken a lot of the tax write-off and use your proceeds to go buy new investment real estate worth at least that much, and you get to indefinitely defer paying the tax on the capital gain and on the depreciation recapture. You get to use that money for yourself, which means you're buying more real estate, which means more income, which it just becomes a compounding effect, right? That $30,000 30 years ago, if I had let it been able to compound for me, how many millions would I have right now from the simple compounding of that money? That's the gist of what the 1031 exchange allows you to do. It's simply selling investment real estate, buying investment real estate, but the government lets you keep the tax dollars for your rent.
All right, that's pretty clear. Is it scoped exclusively into real estate and or any particular types of real estate?
It is only real estate now. That was one of the significant changes to the code a few years ago. It used to be for any kind of equipment. So you
Mhm.
could sell a jet plane and buy a jet plane. You could sell restaurant equipment, buy a restaurant. But now it is only for real estate used for investment. But one of the beauties is, and I know this from the background we were talking about before the show, one of the beauties is that you can go from any type of real estate into any other type of real estate. So if you guys were to throw out two different types of real estate investments into that cage, whoever was still standing at the end could use the 1031 exchange to move from whatever type of real estate they were investing in into that one. So you could go from commercial to industrial to single family. We think about that as an opportunity to shape your portfolio as the market is talking to you.
Yeah, that's incredible. That is super powerful. Are there, I think we were mentioning before the call here, before the show, I'm vaguely familiar with it. I've dealt with it in some syndications that I've been a part of and other investors bringing them in. But are there areas where you cannot transfer? For instance, if one size jumps too big to another size, if you're in a single family home and you make 5,000 and I guess you're only rolling that money into something, are there limitations within real estate?
Yeah, it's actually still pretty broad, and we can
Mhm.
spend a lot of time parsing this out so everybody can see what the possibilities are. But in general, there's three things that are not going to qualify. The first one is your primary residence. Now,
Okay.
this is huge because what a lot of people still don't know is your primary residence has better rules. Section 121 of the code allows you to buy a house, move into it. Once you lived in it for 2 out of the previous 5 years, you can sell it. And as a married couple, the first $1,000 of profit is tax free. You don't need the 1031. That's awesome. And you can do
Yeah.
that every 2 years. So by itself, that's probably the single biggest tax savings opportunity in the code. But it does not qualify for 1031. It has to be investment real estate. The second thing is that if you want to defer a whole tax, you've got to purchase at least as much as you sell. Now, you don't have to, but if you don't, you'll pay tax on the difference. So if you sell a property for 500,000 and you only buy a property for 450, you'll pay tax on the $50,000. But if there's any other gain left, you'll shelter the tax on that. So that's pretty advantageous. The third one, and you triggered my thinking when you talk about syndications, is that it must be actual real estate. And the problem with a lot of you probably been involved is that if they're not set up so that the 1031 investor can buy a tenanted common portion of the real estate, they can't move into syndication because they're not buying real estate. They're buying a membership interest in an entity that owns real estate.
Okay. Yeah.
Which
That
really
jogs
the
my
only
memory.
real-
Okay.
Yeah.
Yeah, that jogs my memory a little bit easier because anytime somebody
Yes.
comes in with a 1031, there is a significant or a not insignificant amount of work that needed to be done to modify the PPM and all of that such that they could become part of the partnership. And I guess it's exactly for that because they're actually buying a real portion rather than
Oh, yeah.
um,
Yeah, that's
the passive.
exactly it. The attorneys start firing the room on their brooms, and the person raising the capital says, make it happen because they want to make it, but it is more complicated.
Yeah. Okay. That makes sense then. Okay. Yeah. I think I've heard the term like for, which is what made me ask a little bit the question if it was okay. But it sounds within certain real estate investment types, you have a lot of latitude as long as you're rolling a similar amount of investment that you profited on back into and you're shielded there. So
Yeah, there's
that
two
makes
phrases that the Irish uses, kind
like
and
kind.
qualified use. And really what those mean, like kind simply means it's real estate.
Yeah. So
That's
not a
like kind.
jet, not, yeah, you sell a house for the jet or
And
the
the,
boat or whatever.
the story is we had to do a lot of machinations to end up getting the sailboat. No, we did. But the other phrase that's used is qualified use. And that simply means that it's used for investment. So it's
Mhm.
not your primary residence and it's not a fixed split property where your intent is primarily to resell. Must be the whole. So as long as it's real estate, as long as your intent is to hold it for productive investment use, it all qualifies.
Okay, that makes sense. I also know, I guess maybe you can discuss what are the rules around it. So I know a lot of times people that I'm familiar with have 1031 and the clock is ticking for them. They have a certain amount of time in which they need to place their funds. And what are the details around that?
Yeah, the timing is really where the devil's in the details. And that's the one that everybody is concerned with the most. But the most important one is the requirement that you cannot do these yourself. You have to use the services of an unrelated third party called the qualified intermediary. And they have to be in place prior to the closing of your sale. I get the calls every month. Someone says, hey, I just sold a property. The buddies at the title company want to do it. And all I can do is just weep with them over the phone because they can't. We were not in place prior to the closing. Now, the nice thing about that requirement, though, is that QI becomes your guide through all of the other regulatory maze. That's why it's so important that sooner rather than later, you get them involved so that strategically they can help you work through what you want to do, but also they've got to be there when the sale closes. Anyways, so that's the most important one. We talked about the fact that it's got to be real estate, the two timing requirements that everybody focuses on. You want to think about your 1031 as starting the day you close your sale. And for that date, you have 45 more days to identify your potential replacement property. No more. It's calendar days. Midnight on day 45, your glass slipper gets left at the vault, and you cannot change the list anymore. So that's what freaks people out, is they're going, can I find the property that quick? How can I do it? The market's tight. Well, that's the price you're paying for mitigating on that tag. But there's some practical things that you could do. The first one is to know that you could go into contract for your new property anytime you want, even before your old property closes. So what a lot of our clients will do, they'll get a contract for their sale. They feel comfortable it's going to close. That makes them feel comfortable enough to go into contract for their new property. So that in many cases, they'll close their replacement property within days or a week of when they close their sale. And that starts to mitigate all that risk and the angst of the 45-day period and feeling that pressure, right? The other thing that does is it lets them restart cash flow that much more quickly. The money's not just sitting there. They're able to reallocate it and get their cash flow started again that much more quickly. So you can go back as early as you want to get your new property under contract. But in any case, you're going to have another 45 days to locate your new property that you want.
And that term locate, what's the nuance there in terms of?
Well, literally, you could take a cocktail napkin and write the address on it, take a picture of it, and send it to me. It literally is just something in writing that says, this is the property. Doesn't have to be a new contract. But remember, after day 45, you can't change your list. So if that was your only property, you're under contract, it falls out, now you're stuck because you don't have anything else you can purchase.
And are there limitations to that list? Can I have 100 properties on the list? Or
yeah, this is where we start getting into the deep weeds on things. Hey, yeah, I know it's a question everybody wants. It's just so crazy. And we just cannot understand why the IRS did it, but they did. If you name 3 or fewer properties on your list, it does not matter what they're worth. So you could sell a property for $100,000 and you can identify 5 $3 million properties. That's perfectly fine. Of course, you got to purchase at least one of them, right? But if you want to name more than 3 on your list, then one of two things has to happen. Either the total value of your list cannot be more than 200% of what you sold. So if you sell for 100,000, the 4 more properties could total more than 200,000. Might be tough to do. Or you actually close and purchase 95% of the value of that list. In other words, if you close on every one of the properties on your list, you're okay. That's pretty restrictive, isn't it?
That is. It definitely penalizes.
Is if you're looking for a property as expensive or more expensive, you're wanting to buy up, keep your list to 3 or fewer. If you're wanting to sell, say, a $500,000 property, and go buy several smaller properties, that's where the 200% rule can be used effectively.
Interesting. Yeah, that was definitely one of the topics that I had in mind. I noticed that you are a qualified intermediary, and I was curious about whether it had to be used or not. But that's a really important upfront bit of knowledge to have, that you need to have that relationship established and have things before the close of any properties.
Yeah. And you've got 80 days to complete your purchase. So like, even if you wanted to name a property that was being constructed, but wasn't going to be done for several months, that's perfectly fine. So that's nearly so angsty as that 45-day period. That's really what you've got to pay attention to. So what I tell people is do the hard thing first. And that's going to be whatever the market tells you. If we're in a crazy seller's market, the hardest thing is going to be to find your property, because Your offers are going to be turned down. You're going to get outbid, et cetera, et cetera. So back in those days, a couple of years ago, we would have California clients who would actually spend months trying to find their new property, get it under contract. Then they would put their old property up for sale and get a full price plus offer with no contingencies on day one, because the hardest thing was to find a new property. As the market starts to shift, the harder thing or the longer thing might be to sell. So get your property ready, get it on the market, familiarize yourself with where you want to go, but get that contract first. Then go find your new property.
Yeah. Wow. That makes sense. So as you walk through it, you mentioned at the top of the show about leveraging these plans to keep, how did you phrase it? But to be able to use your proceeds. I'd like to get a little bit into the nuances of what that is. So let's say you buy an investment property and it's cash flowing, and then you, I don't know, refi or sell it or something. But, and maybe those are probably two different things, but let's just say sale for now. Is it just the proceeds from the sale that are, let's say, at risk? I'm assuming the other cash flow you've already probably taken as income in some way, unless it's same calendar year or something. But
Yeah,
is it?
I get you way where you go. It's an interesting figurated calculation because to do the typical exchange, the IRS is not concerned with how much profit you have. They simply say if you want to defer all profit, you've got to buy at least as much as you sell. And if you buy less than you sell, they say you're taking profit. Now, you and I might say, no, we're not. That's part of my original capital. I put $20,000 down on that property to buy it. That's not taxable. So I want that back and I'll 1031 the rest. And the IRS says, in exchange for letting you do the 10, we're simply going to say that the $20,000 you take is always profit first. And the reason they do that, because then they at least will always get a little bit of their tax. So if you're taking money out, they're going to get a little bit of tax. And so that's why they do that. To do the 1031 exchange, you've got to put all of the original capital and your profit back into the purchase. But what you're really leveraging is the tax on the profit. So if you want to break out the spreadsheet and start having fun doing projections, you would take your net sales price, subtract from that your adjusted cost basis, which is your purchase price plus whatever capital improvements you made minus whatever depreciation you took. And that's your basis. You subtract those two, and that's how much taxable profit you got. So like in my case, my taxable profit was a little over $100,000. My tax was going to be $30,000. That $30,000 is what you do not have to pay to the IRS. Instead, I would have been able to go and purchase more real estate with that. So think of the impact of that. That allows me, I bought more real estate, which means if appreciation is a rate on what you bought, then the more real estate I buy, the greater my appreciation is going to be, isn't it? Let's say if you're familiar with the rule of 72, it's this quirky little rule that says if you take 72 and divide it by the interest rate you're getting, that tells you how long it takes to double your money. So 30,000, if I'm making 10%, and the rule of 72 says it's going to double every 7.2 years. So that 30,000 in 1996 would have doubled in value how many times? 96, 03, 2010, 2017. Four. So 30 doubled 4 times is what? 120, 240. So we would have had well over 500,000 by this time doing that. That's the power of the 1031 exchange. And I call that one of the 4 Ds of 1031 investing, because when you start, you're now deferring the tax and you're getting the compounding effect of that tax as you go. Whether it's 2 days or 20 years, the longer you have it in your hands, the more it's making money for you.
Yeah, that's incredibly powerful to be able to, use that compounding without pulling out the taxes.
Dave, do you mind elaborating a little bit about what is a qualified intermediary and what are your services so
Sure.
people can understand more?
Our services are actually very simple because the IRS doesn't let the qualified intermediary do anything else for the client. So we can't be the client's accountant, we can't be the client's attorney. Our only role is the documentation of the 1031 exchange at the sale and at the purchase, and the qualified intermediary has to hold the proceeds, the bill. So that's why the IRS puts them to be a third party, so that there could be no undue pressure to release money at appropriate times or that type of thing. But that's what the qualified intermediary does, and that's it. Now, I don't want to scare anybody, but the word qualified really doesn't mean a whole lot. It simply means, and I swear, I am not making this up. If you look at the statute, it defines a qualified intermediary as one who is not disqualified.
I love those definitions. Yeah.
There you go. And the only thing that does is if we have a business or family relationship client, your accountant, your lender can't be your 1031 intermediary. The dog groomer down the street could be, as long as you don't take your dog to them. I know that can be very scary because it's a pretty important role. The reality is that it's such a small little niche industry. First of all, you got to be a total nerd to even want to go into it. That's who we are, and we admit it. We're 2 miles deep in a 2-foot wide creek. But the other thing is it generally attracts accountants and attorneys that love the tax code and how to beat it. So that's all our firm is. We're attorneys and accountants, but all we do are 1031 exchanges.
So you're not allowed necessarily to give advice or where people can invest in. You're just helping the transaction.
Yeah, that's exactly right. You use all of your regular professionals just like you normally would. So in one sense, we're like Switzerland. We're everybody's friend and we're completely neutral, which is nice. But there's another side to that this comes into who I am, but something that I would encourage people to look for when you're looking to hire a QI. And that is that although we can't offer legal or tax advice, those of us who have made it part of our journey, I'm going on 30 years now of 1031 investing, have tips and tricks and strategies and guide that you'll never get if you're just talking to an order taker or using a firm where you fill out forms. So that personal relationship can many times just tip the scale in terms of helping you to get to where you want to get to. Because just like we talked about the fact that the 1031 exchange can be used to shape your portfolio wherever you find the market. It can also be used no matter where you are in your real estate investing life cycle, whether you're a first beginner or you're experienced investors like yourself, or you're old as dirt like me. There's ways to use this to benefit. And a good QI is going to be able to steer you through those opportunities.
That begs the question, what makes a good QI if we were to go out and be shopping around for somebody, what are some things that we should look for in terms of wants and avoids?
In one sense, it's like the t-shirt I saw in Key West one time, where on the front it said, a good attorney knows the law. And on the back, as he walked away, it said, a great attorney. So the QI is going to know the law, great QI is going to know the field agent. It's not quite that correct. But a good QI is not only going to know the law, but they're going to know the case law. It's not what the statute says that's so very important. It's how you can use the case law that has come about. The entire statute, Section 1031, is like 2 sentences, but there's 8,000 pages of case law. I'll talk about the nuances. For instance, those opportunities to invest in syndications. How can they be structured? How can I go from active to passive investing? What about mixed use properties for our people who are just starting out? I don't know if you guys started this way. We did. Where you buy the duplex, you live at one side, you're at the other side out. What a beautiful way to start the wealth.
Yeah.
Well, what you've got there is you've got 231 law, where you're talking to someone who can help you out with that. They'll be able to show you how to take part of that money tax-free and then put the rest in it where you're going to get the compounding effect of the rest of the tax. It's those types of little strategies that make all the difference at the end of the day.
Yeah, it's very similar
experience is big.
Very similar to capital raising in that the legalese or the code and the laws are written in such a way, but it's more comes down to the interpretation, right? How have the cases played out in court to know what are the precedents that you need to stay away from or that you can lean into. So yeah, makes sense.
Yeah, that's exactly right. For instance, the things that you're working with called syndications aren't anything really new. They're a piece of property that an organizer or a syndicator has decided to sell fractional pieces. In 2000, there was a type of syndication called a Delaware Statutory Trust that was officially blessed by the IRS as a proper replacement for a 1031 exchange. So on the one hand, you've got syndications you can't go into. You've got syndications that might be able to accept you. And then you've got Delaware Statutory Trust that officially blessed. In the middle of all of those is that path that you want to walk, because it's the case law that determines the eligibility.
Totally makes sense. So Once we are on the 1031 train, and you mentioned in perpetuity, what are the pitfalls, or are there ways to get out other than getting out and forfeiting your benefits? And what does that look like after it turned a few times? Is that the latest cost basis?
Right. Remember, your profit's going forward by way of your basis. So the bigger you buy, the bigger you buy, the bigger you buy, the more profit is backed up. So that
Mhm.
if you ever sell it without doing it in 31 exchange, yeah, the hit's going to be worse. But when people ask me about that, I tell them two things. Number one, don't ever be scared to sell and pay some tax,
Mhm.
because sometimes that's the right thing to do at the right stage in life. If you really are truly just sick and done with real estate, sell it, pay the tax, go invest in Apple or Nvidia, have fun. But the other thing is, don't ever be afraid to pay tax, because nobody in history has ever got broke paying tax on profit. It just feels like it. Sometimes it's worth your while to just say, I'm done, gonna pay the tax. But I just cannot in good conscience leave it at that, because I hate taxes more than hate bills. And this falls into that third D where we talk about shaping it for your life cycle. So when you're starting out, many times we have a lot more energy than we do money. So what are we trying to do? We're going to buy the cheapest place we can, fix it up, get renters in there. Then when we sell it to our 1031, we're going to go buy two. We're going to sell it. We're going to buy four. We're going to change locations. We're going to buy eight. And then we start to realize, dang, I'm tired. What can I start to do? We may have started to have children. You're wanting to start building memories. So you sell several of those, go buy a short-term vacation rental on the beach, just book it out in Colorado, wherever. And you can still generate it, still keep the compounding on the different tax, but also get some personal use of it. So that's another option that's there depending on where you're at. We're starting to have people now do conversion. This one's cool because the 1031 exchange represents a sale of investment property followed by a purchase of investment property, but it doesn't have to stay investment forever. Once you've established your intent, you can change your intent, move into it, sell your current primary residence, because remember, that money's tax free, and then move it to the 1031 property. And as long as you live there, you'll never pay tax. As long as you own it, you'll never pay the tax. So we're seeing people do this to position themselves for retirement. They'll start to sell an Ohio portfolio, go into Sarasota, Florida. And the last move as they leave Columbus is to sell their primary residence, pocket the money tax free, and move into one of their Sarasota rentals, usually the nicest. What a strategy to set you up, because here's
Yeah.
what happens. Once you've lived in it long enough and owned it for 5 years, part of that deferred tax becomes tax free. So if you sell it after you have owned it for 5 years, rented it for 2, and lived in it for 3, you will turn 60% of the profit from tax deferred into tax. Now, what if you laid out 5 or 6 of those and just had them waiting for you? You could eliminate a bunch of tax, couldn't you, over time? And all you're doing is moving into a nicer house.
Wow. Yeah, that's mind-bending strategy going into retirement. Wow.
Yeah, I literally have a guy on St. Pete Beach that bought 3 identical condos in a 1031. They were on the same floor, and he used the first one for rental for a couple of years and moved into it, left the building, lived in it for 3 years. Then they sold it. They got 60% of that gain tax free. And of course, we all know where they moved.
Yeah, next
Next
door.
door. Just kept that rolling. Now, the second best way to eliminate tax happens at the end. It's not my favorite because you got to die to get there.
It's morbid.
But it's
Yeah.
called that. When you die, your heirs will inherit your property at what's called a step up in basis. So they will get the properties if they paid market value for it on the day you died, which means all of that deferred tax over all of those years is not paid by you. It's not paid by your estate, and it's not paid by your heirs. They inherit the property and they can start on their own journey without having the hanker or the burden of any of that tax to be deferred. It's just such a great legacy to leave to those people you love. But first, don't do that first. Enjoy it while you can first, then die.
Yeah, so just to dig into that example, because I think it is really powerful, and it's the essence of why people are using a 1031, right? So you start you start as you can, like if you're starting out like you did house hacking and you've got a half a condo or a half a duplex in there, and then over the course of 20 or 30 years, you're stepping up in value, right? You're buying a bigger place, and then you're buying an even bigger place, and then by the time you get down the road, from what you're saying, is all of that all of the unpaid or taxes, let's just call it that for lack of a better phrase, have snowballed into this final property. And if you were to sell it, that you would be liable for the tax on everything that's accumulated across that 20 or 30 years. But if you leave it to your heirs, they get to reset the value, you're saying, based on the market value of that final property. So
Right.
the legacy taxes get cleaned away, to use a crude analogy, and they are left with just a fresh basis.
Yeah, that's exactly right. Which is actually even a better deal than your IRA because you can actually keep that tax deferred through your life and beyond. Well, yeah, it's not the other thing. I didn't even think about this until my father died a few years ago, and he left to us a bunch of farm land. And I've got 3 other siblings. And in his will, he basically said, I believe that you'll mess, but it's a tax-free mess. So enjoy it. It could be your kids' last memories of you.
Yeah. Hey, it's an incredible gift to be left a responsible estate, not something that there's nothing worse than going through an intimate loss and then having to deal with a mess or something that's been unprepared. And so it is, I know a lot of people avoid estate planning and those trying to put together strategies like that, but it is really, it's one of the best gifts I think you can leave for your family and your heirs. You touched on retirement. Is there any way these interplay together, or are they, and do they have to be completely separate?
In terms of a little further,
So like a 1031 and a 401k, can they commingle? Can you have anything like that? Or are they, by definition, do they need to be completely separate? And
yeah, they're really mutually exclusive because the money that's inside your 401k is tax deferred anyways. So if you're using a self-directed IRA or 401k to buy real estate with, it's all tax deferred. Doesn't matter. The 1031 exists to give you that same tax relief outside your qualified retirement accounts. So about the only time they will come into play is every so once in a while, we'll have a person with a type of account who has used their for part of the purchase and they used outside money for the other part of the purchase. And so when they sell that, it's actually 2 different sellers. One seller is the 401k, the other seller is the individual. And so the allocation for the 401k goes back into it. The allocation that is to the person goes forward in the 1031 exchange. So it's the best of everything. And so you've got it covered tax deferred wise, no matter where you're at, retirement account or outside.
okay. Yeah. So they're separate entities, but can be used together in some cases. So let's talk about, for somebody that, like us, that is not really in any 1031 vehicles, what's the best way to get started in that whole process? I assume maybe it's to get in contact with a qualified intermediary or to help map
Yeah.
out a strategy.
Yeah, it's learning the process and learning the possibilities, definitely. But there is an element of ready, fire, aim with this whole thing, where you got to get started as a real estate investor before you even really understand where you want to go. So my advice would be to buckle a seatbelt, strap in and open up Zillow and let it rip and start to look at real estate. Go, oh, I'd like to have that. I'd like to have that. I don't think I've ever seen a piece of real estate that I didn't think I would like to have, which is probably a good thing I didn't get them all. But the 1031 is obviously going to start when you sell one of those. So the idea is learn what you're wanting to do, fire away, get started, and then see where you're at and where your next journey wants to go. And that's when we can really help you shape it. Because you buy, like we talked about, you might buy a duplex and a house hack. The next step might be to sell it, take half the money tax-free, do it 1031 half. Or maybe you move out and go buy another one. Your career is going to start to be shaped by the success you're having. You may jump right into a multifamily property and it's not in the nicest of areas, and you just go, yuck, this is not for me. I'm going to go with Class A properties and I'm only going to go single family. But yet that's when we can sell that property, use the 1031 to go into what you want. And then there are those people that just say, you know what? I want to be a big gun and commercial real estate. I'm never going to mess with anything but, or large multifamilies like you're saying. The point is that wherever you're at, the 1031 can be shaped to be where you want to go. But you got to start first. Right? Otherwise, you'll end up with paralysis analysis. If you come to me, what should I buy for my first property? Or don't throw a dart. Just buy one. Get started.
There's so many options out there.
Yeah, I'm thinking about, we have a couple of older children that are just starting out in their careers, and we came to real estate later in our life. And I talk to so many people in real estate, and the repeated mantra is, I wish I would have started earlier. I wish I would have started this earlier. I wish I would have known about this, just like your story. I
Yes.
wish I would have known about 10, because it is so powerful and it is so flexible. You can do literally anything. You can house hack, you can fix and flip, you can passive invest, you can go across asset classes. There's so much space. But yeah, for our young adulting daughters, we always think, oh, they talk about, oh, I wish I could have a house. I wish I could do this. And we think house hack, get a duplex. And
Now, are
there's some
they in
really
college now? Are your kids in college?
both just out.
Okay. Okay. One of the things that we've done with our kids, and we've seen a lot of other people do, is a few years before that, they'll 1031 one of their investment properties and buy what we call a kitty condo. So it'll be a condo or even a duplex small multifamily where their children have to go to school. Free housing for the child. They get to manage it, and the rent's being paid by their friends who are living with them as roommates. And then when the child leaves, you sell it, 1031 back into wherever. And if you use the mixed use thing, the example that we used, where you go and buy a duplex, you could put the duplex into your daughter's name. You may have to guarantee the loan. That's perfectly fine, 1031 purposes. But when they sell that property, they're going to get their percentage for what they live in tax free. Your percentage, which is the other half, because you 1031 into it, is going to be tax deferred because they're 1031 exchange. And you just gave them a great graduation gift. So just another thought for ways you can make these things
Yeah.
work. Yeah.
Yeah, it's so powerful. And to your point, not very well known outside of people that are into the taxes and accountants and things like that. So it's unfortunate. But like you said, the government's not advertising a lot of this stuff because it's not in their favor.
Yeah. 2008 really hurt today's real estate investors a lot more than people think. Yeah, it gave everybody these huge buying opportunities. But 1031 exchanges, as they're used today, only really started getting popular around the late 90s. And they were really growing in popularity. 2005, 2006, there was about 600,000 exchanges done. But then when 2008 happened, everybody was just starting to do this. We lost 80% of our investors. 2/3 of the realtors in America went out of business. A lot of QIs went out of business because there was no more profit. And so all of this knowledge that was just starting to get momentum disappeared. Biggest buying demographic now, this freaks me out. I hate to even think about it. But the biggest real estate purchasing demographic now in 2008, when we all endured the crash, they were in middle school. What do they know about
Yeah.
what was happening? That absolutely nothing. So
Right.
we've had to rebuild that book of knowledge. And now people are starting to receive it happen more. But the key has been education. And that's where I've chosen to make my focus because I think it benefits people more. And it also generates more business because there's a lot of people that would love to do this, but just don't know. And it's like Steve Jobs said, people don't know what they want until you show it to them. People don't even understand the power of what the 1031 could do until you show it to them. And then there's no stopping.
Yeah, that's a really relevant and powerful statement. And speaking of education and books of knowledge, I think you have a book on this very topic.
I have a book. Yeah, 8 years in the making. I'm like really slow. It's called Lifetime Tax-Free Wealth, the Real Estate Investor's Guide to the 1031 Exchange. It really just goes through. I thought I was going to be writing a how-to book, just the deep in the weeds. Here's the rules. What ended up writing was what I think came to be one roadmap to achieve your dreams. But that roadmap can have a bunch of different exits and entrance and off ramps and routes to get to where you want to get to. So it was fun doing that once I realized that was really where I was going. And we chocked it full of real case studies, people that we've actually worked with over the years. So you can say, here's how someone did it who raised their kids, helped them get through college. Here's how this military guy did it to buy at every station he was at. It ended up where he wanted to be. Here's how this guy is where he wanted to retire at the same condo building and all of those stories. But you guys have a story. And that story, I kind of feel it sooner or later is going to involve 1031 exchange. Now that I see the light bulbs clicking on. For us, it was we wanted to go live on a sailboat, live in Denver. How do you do that? Become a real estate investor. You use 1031 exchanges and primary residence exemptions to move your portfolio to Florida and buy a sailboat with tax-free dollars and raise your children on it for 10 years while you live off the money from your fleet of vacation rentals. That was our story. So no matter where you're trying to get to, I think there's a way you can use the 1031 to help.
Oh, most definitely. Most definitely. That's powerful. Where can we get a hold of your book?
You can pick it up at Amazon, Dave Foster, Lifetime Tax-Free Wealth. You can also find it on our website. And we've actually got a bunch of different tools on there as well. Some calculators that will help you, a channel that you can go to and check out. We're always putting up current shorts, different little strategies as they come available. And we think of them. But that's it. It's 1031investor.com.
All right. And if that's not the best way, what is the best way for people to get in touch with you?
Right there's got all my phone numbers and everything. We have a whole fleet of people. I got more than a touch of if you put a piece of paper in my hand, I'm going to hand it to someone and say, please read this for me. I don't want to be bothered. So we've got people that fill out the paperwork. I want to talk to people and hopefully strategize. That's the fun. So go to the 1031.com. You can check us out there. Book an appointment. We'll chat.
Love it. Dave, thanks for coming on the show today and sharing just some insightful bit of wisdom in the power of real estate, and also how to even further leverage the power of real estate to achieve your vision and dreams. It's been an eye opener for me, for sure. And yeah, we have some properties that we've invested in that are coming due this year and or next. And certainly 1031 is not quite top of mind, but it probably just moved a little bit more to the top of the mind to figure out how to do that and strategize this next chapter of life. But it's been a pleasure, man.
Yes.
Wish you all the best. And thanks again for coming on the show.
Yes, thank
It was
you.
great being here. Thanks so much.
All right. Take care.
For those of you joining us today, we hope you enjoyed this time in the Champions Corner as much as we did. Got some awesome takeaways, and most importantly, will take action to continue living your best life and maximizing your potential. Mindset is such an important aspect of life, and when coupled with action, delivers undeniably powerful results.
Please subscribe to the podcast to hear from more great guests and get the latest mindset mastery insights and cash flow matchups.
Again, thank you so much for investing your time with us, and we look forward to seeing you next time on the Cashflow Fight Club podcast.